We know most traders aren't profitable, and why is that? They don't know how to get their daily bias. Here at Momentum Funding, we're committed to making better traders. So I'm going to show you a better way to get the daily bias so that you can approach the market with more confidence. Now, I'm personally a gold trader, and I'm going to show you how I approach gold, but what I'm going to teach you today can be used to approach any instrument, as the same approach works across the board. Now, professional traders don't just hit buy or sell. They build their bias based on 4 different components. You have your fundamentals, you have your market sentiment, you have your market conditions, and you have your technicals. Notice how I said technicals is last. Most retail traders get this backwards and they only focus on technicals and ignore the other 3. But what do we know about retail traders? Most of them aren't profitable. Most days you should have a bias before you even look at the chart. And today I'm going to show you how I use these 4 components to position myself properly before the move, not after. Just so you guys can be ready for how this video is going to be structured. We're going to do 2 parts. The first is theory, the second is application. The theory is going to be me explaining the 4 components, how they work, and what you should be looking at and what they are. The second part is going to be application, and it's going to be you and I jumping on the charts, and I'm going to show you exactly what tools I use so that you can do the exact same thing so that you can be ready for the markets as well. If you like what I have to say here today, get into Momentum's Discord, because on Sundays we host Momentum Market Edge, where we break down the market and what to expect for the week so that you could be ready and approach the market with more confidence. I'll leave the link down below. So component 1 is fundamentals. What's really driving gold price? The real drivers behind gold are global forces. You have your central bank buying and selling, you have your raw mining supply, you have the actual demand for the mining supply, and then you have the macroeconomic shift. Then we layer in the interest rates of the US dollar, and that gives us more of a reading. So if the interest rates are higher, gold is less appealing. If the interest rates are going down, gold is more appealing. These aren't just economic stats, they actually shape the movement of the asset day to day. Component 2 is market sentiment. Is the market risk on or is the market risk off? How are the investors currently looking at the whole market as a whole? So if the market's in fear mode, gold's gonna rally. What does fear mode look like? Your global conflicts. For example, we have the Russia-Ukraine. There's some conflicts with India and Pakistan. There's some conflicts with Yemen and Israel right now. Add some trade wars and Trump into that, and now you've created a global catastrophe where the market's uncertain. What does the market do? They pull their money out of stocks and they put it into gold. Now, gold's a safe haven. If we have optimism in the market, the demand for gold is gonna fade. What does that look like? Russia and Ukraine sign a peace deal. Trump stops tweeting about putting tariffs on everybody. China and US make a trade deal. Now the market calms down. There's no more demand for the safe haven. So what happens? The money flows back into the equities, which is your stocks. The reason sentiment is so important, you can catch the move before it even prints on the chart. So the other day, Trump made an announcement that he had a big trade deal to announce with a major player. Gold started kind of doing a bearish retracement on the 1 hour, even though the daily was bullish. So I tuned in at 11 o'clock to see what the news was. The news was that the UK and the US just signed a major trade deal. Right away, I looked at the chart. I was like, I'm only looking for sells today. And I took a sell. I took a quick stop loss. I got back into a sell, and gold ended up dropping about 400 pips. I caught the whole move. I was able to catch this move before the candles even started moving, because I knew what was likely coming based on the sentiment that was out in the market, that a trade deal is made, and now we have more optimism for the market. So gold is more likely to sell off. Component 3 is market conditions. This one's often overlooked. And why is this important? Because you can't treat a different kind of market with the same rules that you treat another type of market. For example, you have a trending market where most money is made, and then you have a liquidity market, or also known as a technicals only market, or also known as a consolidation market. In a market like that, you're going to play the edges. You're going to barely take any trades. When the market's trending, this is where you can be more aggressive, since this is where the majority of your money is going to be made. So this determines how I'm going to trade this market, or if I'm even going to get involved based on the information I have. So if it's a trending market, I know I can get in aggressively. I know I can break even quickly. If it's a consolidation market, I'm going to be a lot more conservative. I'm not going to get in as easy. And if I do decide to get in, I know I have to be comfortable with leaving my stops open, because what does a consolidating market do? It deeply mitigates multiple times and it goes from edge to edge. What does a trending market do? With gold, it usually just goes and it barely pulls back. So those are the trades I can manage aggressively as well. I can break even, take my risk off, where as soon as it's consolidating, I have to leave my stops open for a long time. And because of that, I'm going to take a lot less trades in consolidating markets compared to trending markets. Now we have component 4, which is your technicals, which is all anyone teaches, which is completely wrong. Technicals are important, but they come as number 4 out of all the things I listed. So when is technicals number 1? Only when we're in a liquidity market and there's no fundamental drive. At that point, it's a technicals only market. And only in that condition position is technicals first. Everywhere else, technicals is number 4. So now and only now do I look at the charts. So for myself personally, and what I also recommend you do, you use some higher time frame to get a bias. So I use the daily chart and I use the 1 hour chart. Daily is the main direction, 1 hour is the sub direction. What I do is I map out my ranges, which I will show you how to do, and I mark out my session lows and highs, and then I go from there. So I pair my ranges with moving averages when the market's trending. When the market begins consolidating, I actually turn my moving averages off, as they can just get confusing and they provide no actual help that we see volume pump in. How do we know we have volume? Vector candles, imbalance candles, anything that implies that volume's being pumped in. Whether it's news that causes that or the candles just start moving, we need momentum in the markets before the moving averages become handy. So here are the rules. If fundamentals and sentiment is clear, technicals are just going to help me get an entry in that direction. If technicals, sentiment, and fundamentals are all heading in the same direction, that's a high probability trade. Those are my favorite trades. Those are the trades I will add multiple positions on and scale risk in. That is my biggest money makers. If we're in a liquidity market, it's a technicals only market. So if we're in a technicals only market, also known as a consolidation market or liquidity market, I only play the edges. So what do? I wait for liquidity sweeps of Asia highs or lows, daily highs or lows, or I pull my fib on the range, and I'm only willing to get involved in the last fib mark, which is the 786 of my fib. Anywhere in the middle is usually where you become liquidity, so I avoid that completely unless it breaks out of the range, retests, and only on the retest will I look for an entry. So I'm very conservative when it comes to a technicals only range. Like, I'm conservative to the point where I'm willing to set a week out if I need to. So the 4 components I just named off is how I get my daily bias. It is my entire edge. It is my rock. It is everything I trust. And now what I'm going to do is we're going to go on the charts and I'm going to show you guys exactly what I do. So make sure you tune in to part 2 of the video. If you already haven't, definitely check out the description below and get into Momentum's Discord as we continue providing value to you guys, and we will continue doing that for as long as Momentum's a company.